Why is an investor who protects their attention at an advantage? A behavioral finance and cognitive science perspective. In modern markets, capital is important. Information is important. But attention may be the real scarce asset. An investor who protects their attention often gains structural advantages, psychologically and financially. Here's why. 1. Attention is a limited cognitive resource. According to Daniel Kahneman, attention functions like limited mental bandwidth. When investors constantly consume news, price movements, social media opinions, market alerts, they deplete cognitive capacity. An investor who limits exposure preserves analytical clarity, reduces decision fatigue, maintains long-term focus. Energy conserved becomes discipline preserved. 2. Reduce myopic loss aversion. Research by Shlomo Benartzi and Richard Thaler shows that frequent evaluation increases sensitivity to losses. More checking, more perceived losses, more risk-averse behavior. An attention-protecting investor checks less frequently, experiences fewer emotional loss events, maintains higher long-term risk tolerance. Over decades, this matters enormously. 3. Lower emotional volatility. Markets fluctuate constantly. If attention is constantly attached to short-term noise, emotional spikes increase, impulsive reactions rise, regret cycles intensify. Neuroscientific research shows that emotional regulation consumes cognitive resources. By reducing exposure, the investor reduces emotional activation. Lower emotional volatility equals better decision stability. 4. Deep thinking versus reactive thinking. Frequent interruptions fragment cognition. Cognitive psychology consistently shows that task switching reduces deep work quality. An investor who protects attention thinks in longer time horizons, evaluates strategy rather than price, focuses on structural allocation decisions. Reactive investors respond to movement. Focused investors respond to fundamentals. 5. Less narrative distortion. When attention is glued to short-term prices, the brain builds stories. The market is turning. I should have acted. I'm missing something. Behavioral research by Daniel Kahneman shows humans overinterpret randomness. Protecting attention reduces overnarration of noise. Fewer stories, fewer unnecessary trades. 6. Protection from social contagion. Social media and financial news amplify urgency. Exposure increases. Fear of missing out. Panic during downturns. Comparison anxiety. An investor who controls attention avoids emotional contagion. Independence is easier when noise is filtered. 7. Compounding requires calm. Compounding works quietly. It does not require constant engagement. But impatience destroys compounding through overtrading, strategy switching, risk mismanagement. Attention protection supports consistency, process adherence, long-term compounding. The edge is not informational. It is behavioral. The structural advantage. An investor who protects attention experiences fewer emotional triggers, makes fewer impulsive decisions, maintains higher risk tolerance, preserves cognitive energy, avoids narrative overreaction, stays consistent longer. Markets reward consistency more than activity. Practical implementation. Define fixed review intervals. Disable non-essential notifications. Automate investments and rebalancing. Limit financial media consumption. Separate analysis time from monitoring time. Attention is capital. Those who guard it carefully often outperform those who spend it constantly. Core insight. In a world overloaded with financial noise, the investor who controls attention controls behavior, and behavior drives long-term return.